Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the individual pension plan. Now, before I go anywhere with this, I want to qualify this video very succinctly. This is in no way intended as advice. This is purely general information for education purposes. If you are watching this video with any thought about using this information to establish an individual pension plan, it is an absolute must that you involve a qualified actuarial firm in the construction of any individual pension plan, and recognize that once you have an individual pension plan in place, that the advice from a qualified actuarial firm is a must on an ongoing basis. You simply can't do this without a qualified actuarial firm. Now, when do you need this? Well, for study purposes, this is something that you only have to have a passing knowledge of for the purpose of the life license exam or the mutual funds exam or the Canadian Securities course. If you're pursuing the Certified Financial Planner designation, then you'll have to have a little bit more knowledge of this beyond just a passing knowledge. You'd have to probably know all the points that I'm going to illustrate on this slide. And if you're pursuing a designation like the CEIBS Compensation Specialist, then you'll want more than what I'm going to do in this video, but you still might find this video useful for things like context and sort of a broad understanding. Now, it will be useful to have watched any defined benefit pension videos and RSP videos before watching the IPP video. If you're just launching into the IPP, without knowing how an RRSP works and without knowing how a defined benefit plan works, you will be lost. And that's simply the nature of this fairly complex instrument. So what is the IPP? Well, let's start off by looking at who uses it. And that helps to disqualify a bunch of considerations, and it helps us to properly consider some of the things we have to know about it. So it's normally used by small business owners. It doesn't have to be. You will occasionally find it used in a sort of big business compensation structure, but by far more common for small business owners, usually in an owner-operator type of situation. So, for example, dentists and medical doctors would be probably the two biggest users as far as demographic groups of the individual pension plan. We're normally going to use, normally looking for somebody who's age 40, about 42 and up, although I will show you that it doesn't have to work like that, that you shouldn't restrict yourself to that market necessarily. There are some relatively recent innovations in terms of individual pension plans to get past that age limitation. We're normally looking at, we have to have somebody with a history of T4 income, and usually $100,000 and so and up of annual income of T4 income. Really, if you're up in the 150 range, that's even better, but somewhere north of 100 is usually where you're starting to get the efficiencies you need to make the IPP work. And we're normally looking for somebody who is probably going to have their business for a while. You don't want to set this up and then 3 years later you're selling the business or winding up the business. There's a fair bit of complexity associated with this thing, and generally you want to have enough planned future with the business that this is probably going to work for you for a while. And you're also typically looking for a business with good cash flow. So if we can establish all of those criteria, then we have a candidate for at least examining whether the IPP might be appropriate. So in order to understand where this fits, it's best to start with the RRSP, just a basic RRSP issue. So with the RRSP, and I'm going to do this very generally, but the RRSP we know is based on 18% of earned income up to a maximum. And that maximum is indexed every year. It doesn't really matter, I don't want to get too fussy on this, but that maximum is normally, well, it's based on about $140,000 of income. It's a little higher than that today, but let's call it 140 for the sake of argument. So we can do 140,000 times 18%, and that's going to give me $25,200. That's about where the RSP maximum sits. Like I said, it's a little higher than that today, but just to keep the math easy, we'll just use 140 times 18%. So if you look at somebody at any given age throughout their working life, let's say from ages 18 to 70, and let's say that person always makes $140,000 a year, all through their working life, well, times 18%, we know they would be able to put away $25,200 per year into an RRSP. Now, I know that figure would be inflated. Let's ignore the effects of inflation. We don't need to complicate this any more than it's already complicated. If you have a defined benefit pension, this is a little bit different. And this is really where the IPP's kind of magic sits. So with a defined benefit pension, you still use the RRSP limit, but it kind of works backwards. So you would take that same $140,000, that same number, and you would multiply that by 2%. And so 2% of $148,000, $2,800, that's the maximum benefit that you can accrue for a DB plan in a given year of employment. So if we kind of compare this, let's say that I pull out 30 years for the RRSP contribution side. So you got 30 years of RRSP contributions. Well, over that time, you would have put in $25,200 a year for 30 years. And you would end up with about $750,000 sitting in an RRSP. The math is not really relevant there, just to recognize that that's about how that would work. Whereas if you did the same thing in a defined benefit pension plan, you would have a benefit based on, you'd have a $2,500 annual benefit times 30 years of service. So now you have a benefit at $81,000 a year, which the idea is that those are supposed to be roughly sort of matched up to one another. But let's look at a couple of different scenarios here. So now in order to make this work, we're going to isolate out 1 year of service. Let's say for the sake of argument here that we pull out age 30. So I've got somebody who's 30 and we're looking to fund the RRSP. Well, if we use the RRSP to the maximum extent, as I show over in the pink and blue on the left side, we'd have about $25,200 into the plan. That's exactly what we'd have. Whereas if we use the defined benefit pension, the question is, how much has to get put away to fund that $2,800 a year promise that's made to the employee? And I don't care if it comes from the employee's pocket or the employer's pocket or whatever the case is. That's not the point of this portion of the video. We will talk about that for the IPP in a couple of minutes. But how much has to be put away to fund that $2,800 promise? Well, really what you're going to do here, you do a couple of present value calculations. You do a present value of a $2,800 annual cash flow in retirement. And then you do the present value of that present value, and that tells you today's obligation. So basically, that answers the question, how much has to be put away to fund that $2,800 a year promise? And depending on the assumptions you use, for that 30-year-old, that's going to be around, call it about $17,000, maybe a shot less than that. Again, it's going to depend on the assumptions you use, but around 17,000. So in fact, you can see for the 30-year-old, to get to the maximum possible defined benefit, that $17,000 commitment, it's less than what you would need in an RRSP, less than the RRSP maximum. Whereas, if we take a different person now, we isolate a different year of service, and now we're going to isolate out, let's say, age 50. And again, the same thing. If we use the RRSP, we've got $25,200. But now if we ask the question, how much has to be put away, still to fund that $2,800 promise, the difference here is that we have 20 less years to get to that present value. So with less time available, we have to put away more money. And what this is going to do, it's going to drive up that cost. Now, that's going to cost you about $30,000, which is more now than the RRSP maximum. And it's really here that the IPP gets most of its advantages. Because now, consider the small business owner, like I showed up in the dark blue on the top left here. And this small business owner has good cash flow in their business. They don't mind putting away more money. In fact, for them, the more money they have in their retirement pot when they retire, the more lucrative their retirement will be. They're not really buying a defined benefit. What they're really buying here is a pool of dollars that's going to be available for them in retirement. So now let's flip back over here to the pink, and we can see that something like this starts to happen at about age 42 or 43, that the defined benefit limit, which then subsequently is what gets used to calculate the IPP limit, starts to crank up over that $25,200. So for example, we just estimated that at about age 50, that's going to be, call it $30,000. And you can kind of approximate these numbers. At age 45, it's going to be about, call it about $27,000, so already more than the RRSP maximum. By the time you're at age 60, you're looking at numbers around $50,000. So now you can really crank up the amount that's going into that pension. This is what we're really opening the door for our small business owner to do, where we say, look, would you like to be putting away $25,200 a year until you're 70, or would you like to be putting away $27,000 and then $30,000 and then working your way up to $50,000? And our small business owner, if they can afford it, this is going to give them a larger pool of registered savings. It's going to be funded straight out of the company. So you don't have to take money out of your company to do this. Now, you do have to be taking T4 income to create the RRSP room that you need to fund this, but you're just going to have your corporation write a check to whatever investment manager is managing these dollars. That pool, that IPP amount, is not a business asset. And this is really something more for when you're talking to the accountant, but this allows potential use of the lifetime capital gains exemption. And sometimes you'll get a business that's sitting on a big pool of passive cash. We move that over to an IPP, and that can allow the lifetime capital gains exemption potentially to be used. There's a bunch of other circumstances that we have to see in place as well, but that's basically how this works. Unlike your defined benefit pension, this does create estate value. So what you could potentially look at here is naming a beneficiary on your IPP, and then when you die, if you die prematurely while there's still money in here, that person just gets the defined benefit. The other thing that can happen, actually, kind of a curious thing, is you can have up to 3 beneficiaries. And with that group of up to 3 beneficiaries, they all have to be family members. So this only works when you have a family business. But the first one dies, the IPP is still intact. The second one dies, the IPP is still intact. The third one is left with this huge IPP that funds their retirement and potentially creates estate value for their eventual beneficiaries. Now, what really happens with the IPP? A couple of things that we have to consider, practical considerations. Funding it, that when you start it, you often need an initial funding obligation to be met. And that can be kind of a downside. What happens here is you take your personal RRSP, which would be non-locked in dollars, and that gets used to basically catch the IPP up, so that you would have to look at how much money would have to be there to fund the defined benefit pension that you've just set up for yourself, and do you have money in an RSP right now? If you do, you take that and you get that transferred into the IPP. That makes those non-locked in RSP dollars now locked in IPP dollars. And then you can have what's called terminal funding, and this is when you retire, and this is now another transfer of corporate dollars to make sure the IPP is fully funded. Now, fully funded is kind of a misnomer here. That's all based on that defined benefit calculation, but really all you're going to do when you retire, you're not going to actually turn this into a pension. So really what happens here is on retirement, you're going to move to a LIRA and then a LIF, and just start taking LIF income. And now it works just like any other LIF. The difference would be that you've been able to get a lot more funding into that LIF because of the combination of, over on the left side now, of that larger level of funding than what the RSP allows, and because of the initial funding and terminal funding obligations, which require this thing to really get cranked up. The other thing that you have to look at here, it is a pension while it's accumulating, and because it's considered to be a pension, you have pension obligations, which means that you have to report this to your pension supervisory authority. So whatever province you're in, there will be a pension supervisory authority, and they want to see that the pension is properly funded to meet its eventual obligations, which are only to you. The consequences of not meeting those obligations vary by province. They are sometimes pretty minor, but sometimes it can create real problems for your company. So we're going to report this to the pension supervisor. If it's underfunded, then the company must top it up. And actually it works out legislatively to a requirement for the IPP to generate a 7.5% return on investment, which can lead to a lot of extra top-up requirements from the company that's funding this thing. So I hope this makes sense. I know that it's a fairly convoluted tool. I think I warned you at the beginning. I haven't gone into every last detail with the IPP. I've tried to give you a good broad understanding. I will mention one more thing. Actually, I should mention this, and then we'll wrap up. And that is that IPP contributions create a pension adjustment just the same as a defined benefit pension adjustment. So basically, you're going to lose all your RRSP room. You won't have an IPP and an RRSP sort of happening at the same time. If you're funding an IPP, you probably have no more new RRSP room. Sorry, that's an important point. So again, lots of detail behind this thing. You must use a qualified actuary to help you set it up. But when the circumstances are right, and you can see that it's that fairly narrow set of circumstances, then it can work out well. And sorry, I know I said just one more thing. I'm going to show you just one more thing. And that is, traditionally, IPPs have been used where this defined benefit limit really supports it. But you'll see this now. You'll see some IPPs, and we're on the left side in the pink here, some IPPs that use a defined contribution model, which is more like the RRSP model when the circumstances aren't just right for the defined benefit model to work out. And you can actually even, although it does require some advice, flip back and forth between a DC funding model and a DB funding model. That can help you get past that age 42 kind of restriction, and it can also actually help in an underfunded year or in a year when there may not be any T4 income. The DC model sort of supports that more straightforward calculation a little bit. So I hope that's helped. I hope that you've got an understanding of the IPP, at least a very cursory understanding. It is complicated. It's potentially rife with complications for the business owner, for the advisor who brings it in. I do see a lot of questions around IPPs from people who have put them in place or are using them. And often there is some frustration that comes about when we can't get the IPP to do exactly what we want later on. It's not always as flexible as we would like. It really is a defined benefit pension in that regard. And you really have to think of yourself like an employer putting in place a defined benefit pension and having all the handcuffs that go along with that. So I hope that helps, and I hope you enjoy your continued studies. Thank you very much.